Directional movement indicator and average directional movement index. The directional movement indicator DMI is a trend following indicator developed by Velas Wilder that attempts to measure market strength and direction. Instead of using closing price of each period as input, DMI uses each period's net directional movement. If plus DI is greater than minus DI, then the market is said to be trending higher. If minus DI is greater than plus DI, then the indicator suggests a bearish trend. The average directional movement index or ADX is an index of relative strength of market trend. It is derived by applying a 9-period smoothing of result of dividing difference between the absolute value of plus DI and DI by the sum of plus DI and DI. Parabolic, the final indicator driven triggered trend following method that we will examine is Wilder's parabolic or stop and reverse SAR. This is another trend following system that is always in the market and whose stop and reverse trigger points take on a parabolic shape as trend matures. Price triggered trend following indicators. Donchian's channel breakout. Richard Donchian's nth period or channel breakout system is not only a price triggered trend following indicator but also a comprehensive stop and reverse trading system. Percentage oscillators. Stochastics was developed by George Lynn and is based on principle that as market reaches temporarily unsustainable extremes, daily closing prices tend to be closer to upper that is overbought or lower that is oversold end of each day's range. Fast percent K or percent K measures on a percentage basis where the latest closing price is in relation to total price range over a specific period of days, which is 9 and 14 days, are the most commonly used default values. Fast percent K is used in calculation of fast stochastic. The more popular slow stochastic is generated by calculating slow percent K, which is 3-day moving average of fast percent K. Traditionally, buy and sell signals are generated when the slow percent K line crosses over the slow percent D line in overbought or oversold territory. Overbought is usually defined as somewhere between 70 and 80 and oversold readings between 30 and 20. Although it is possible to develop a moderately successful trading system using SKSD crossover, relative strength index RSI is a mean reversion indicator because it is among the most popular and well known of the oscillators. Like stochastic, the RSI is plotted on 0 to 100 scale with the 70-30 combination as the most widely used overbought and oversold boundary parameters. Differential oscillators. Differential oscillators are based on difference between two data series, in contrast to percentage oscillators, which range from 0 to 100. Differential oscillators have no numerical limit, and so determination of overbought or oversold level is problematic. Momentum and rate of change. The momentum and rate of change ROC oscillators produce remarkably similar results because they both measure the closing price of X periods ago. Statistical oscillators. Statistical oscillators are based on statistical measurement known as standard deviation, a mathematical measure of how widely dispersed a data set is from its mean. Instead of comparing current prices to past price on the relative percentage basis, statistical oscillators compare current prices to statistically measured amount of past price movements. Bollinger Bands, which were popularized by John Bollinger, who started as market technician on CNBC, are constructed by calculating the standard deviation of prices over a specified period of time. Bollinger used 20 periods as his default value and then adding and subtracting two standard deviations to simple 20 period moving average.